The house always wins. Everybody knows that. That's why casinos are paying for your hotel and paying for your food, because they're always making money, a lot of money. How do they do it? What is an edge? And how do we trade like a casino? Hey guys, welcome back to the channel. And today I wanted to define what is a trading edge and how do we develop a trading edge. So I made a little presentation for you. Let's take a look. What is the trading edge? So we need to understand probability and we need to be like the casino. The house always wins. That's why the casinos are buying you all the food and paying for your hotel rooms, fancy hotel rooms and whatever, because they know that they're always making money, and the only way they're going to make money is if they bring you in. So how does it work? So let's start with a roulette wheel. I learned this from Adam Khoo about 4 years ago or something, and I thought it was awesome and I wanted to share it with you guys. So on a roulette wheel, there are 18 reds and 18 blacks and 2 greens. So if you don't know how to play roulette at all, you basically bet that when they spin the wheel, it's going to land on either a red or a black. You say, I'm betting on black. So you could bet on red or you could bet on black, but the casino always wins with the greens. So how does it work out? Suppose you bet on black. Your chances of winning are 18 out of 38 because there's 18 reds, there's 18 blacks, and there's 2 greens, and the casino wins with the greens as well. So if you bet on black, you have a chance of 18 out of the whole 38. That's 47.3%. The casino's chances of winnings would be, in that case, all the reds and the green, which is 20 out of 38, which is 52.7%. So this means that the casino has a 5.4% edge in roulette. That's calculated by taking their 52.7% probability less your 47.3% probability, which gives the sum of 5.4%. So every time that a person makes a bet on the roulette, they have a 5.4% edge. That means for every dollar bet on the roulette, the casino would make 5.4 cents or 5 cents. Doesn't sound like a lot, but if there's $1 million of bets, which there likely is in the casino, maybe in a quarter or who knows, depending how big the casino is, in $1 million of bets, the casino would make $54,000. Now, we need to trade like the casino. The casino doesn't care that this bet they lose, and even if there's a winning streak, a number of streaks going on at the same time, and today was a bad day, this week was a bad week because there's so many customers coming in and winning, they know that as long as there's enough bets, they're always going to win because they have the edge. That's how we need to be as well. So first of all, we need to only trade repeatable price patterns. Those are the ones that have the edge, the ones that we've seen before, and it's not 100% of the time that we're going to win, but we have a little bit more than 50%. There's a good chance they're going to win, and I'm going to show you an example soon. Secondly, we need to manage our risk to reward ratio, and this is something the casino doesn't even have, because with the casino, they're betting 1-to-1. For every dollar, they might win the dollar or they might lose the dollar. We have a possibility, and I'll show you what I'm talking about, to bet 2-to-1 or even 3-to-1, that for every dollar we bet, we have a reward possibility of $2, or maybe for every dollar we bet, we have a reward possibility of $3. That is something that makes our possibility of trading like a casino even better than the casino themselves. But something that is so important to expectancy, which is the ability to know how much you're going to make over time. Like we saw that the casino has a 5% edge on roulette games. So too, in order to have positive expectancy, we need to make sure that we keep our trades all the way to the end. That means that we don't cut our profits short and we hold them all the way to the end, which for many traders is not the case. That's not what they do. So let me give you an example. Here we have a 2-hour chart on the Swiss yen, and it was ranging. So the repeatable price pattern here is that when it gets to the top of the range, you're going to want to sell. When it's high, you want to sell. And when it gets to the bottom of the range, you're going to want to buy. But notice how in each one of these trades, I always took a 2-to-1 ratio, meaning that if whatever I was going to risk, I was going to make double. So as the range was developing, as you see my cursor over here, here's the first top. Then it hits this bottom, and here's the second top. So the fact that we have two tops over here is already enough to define it as a place of resistance. We wouldn't know that there's a range yet at this point, but at least we know that there's resistance up here. So once the market starts to go lower, I'm going to get in, and you see over here that it's the risk to reward ratio is 2. It was 22.6 pips is my stop loss, and 45.3 pips is my target. And I stayed in, and I went all the way down and got the 2-to-1. Then the market made a second bottom. So now we could look at it as a range because there's two tops and two bottoms. That's enough to define it as a range, and I'm gonna make the box, and the box will keep on going. So it did hit the bottom and went back up, but I didn't shoot it yet. I didn't trade it yet because I didn't know that it was a range. And it goes back up and up and up. And when it hits the second time it hits the top, we're gonna get in again right after. And again, we're gonna go for 2-to-1. Again, this is 21.7 pips as my stop loss, 43.5 pips as the target. And again, it went. Now, it went back up and it did break the range over here, but it tested and it seems like it failed. So at a certain point, after it failed, when it broke this little support line over here, feel it's safe to get in again, and you protect the trade by covering it with the top of these previous highs. That's where your stop loss would go, which was 30.1 pips. And we go for the 2-to-1 ratio, which is 60.1 pips. And again, it made it. Then the market went all the way down and did break past the bottom of this range, but immediately was pushed back up by the bulls. So again, another time to try it out. And here we go again. This one took a little bit longer. It actually went up and almost came down, but it did quite just make it. And then when it did go to the top, another time, it's fair to go short again. Basically, these are the repeatable price patterns. It goes up, we are going to assume it goes down. And if you lose, you lose, but we have the edge. We're assuming that this is repeatable, and this is something that could be done again and again. So until it stops happening, we just got to keep on doing it. So here's one shot, here's a second, here's a third, this fourth one, and then right after it goes to the top and has this bearish candle, again, you want to go short because it's at the top. And then it hits the bottom, and again, you want to go long. So, and then again, it hits the top, and you want to go short again. And even again, it hits the bottom, and you're going to go long again once it passes this support line. That one almost did make it. Look how many we have here. It's unbelievable. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This is a 2-hour chart. So that means we could measure it over here. In a total of 28 days and 18 hours, we had 1, 2, 3, 4, 5, 6, 7, 8 possibilities of just trading the tops and the bottoms, going for the 2-to-1 ratio. So what you clearly see over here is that this is something that's very powerful. We want to go with the repeatable price patterns because that makes us like the casino in the fact that we have the edge. We know that more than 50% of the time, it's going to go down when it hits that resistance point, or when it hits that support point, it's going to go up. And not only that, we have the possibility of managing our risk so that we're going for $200 when we're risking $100, or whatever it is your risk to reward ratio is, but make sure it's at least 2-to-1. And then finally, this is really a hard part for many of the traders, is to hold your profits all the way. Don't think about this one trade. Be like the casino. The casino doesn't care if they have a losing day, a losing week, because they know in the end, over a series of bets, they're going to reap the profits. And so too with us. If we stay in the trade all the way to the end, then and only then will our trading edge blossom. And it could be a great trading edge. Guys, this is what you need to know. This is how you have a trading edge. And these are the types of things that I teach in my course. I'd love you to check it out. Look at the description below. It's helpwithtrading.com. It's actually a free course right now to all my subscribers. And I hope you like this video. And if you do, you can give it a like, subscribe to the channel where I'm putting out a lot more content right now. More on the trading psychology, developing a trading edge, risk management, and all these things that are the real important things to make you a consistent, profitable trader. So, till next time guys, DD out.